Alright, good evening ladies and gents, welcome back to Compound Interesting. In today's video I want to explain why the Fed has absolutely no choice but to turn the money printers back on, and I want to explain when I think they will have to do this by. So unfortunately in the last couple of years everyone has had to become a macro expert, myself included. I'm now officially a macro expert, so I know everything there is to know. No, but in all seriousness, I wanted to just explain the situation in as simplified a manner that I possibly can, and how exactly I'm hoping to profit off this situation over the next coming years. So firstly, the situation right now, everyone knows inflation is an absolute killer and it hurts the neediest the most. Like, the rich people don't really care if a avocado smash goes up 20% than it was last year. However, the needy, the plebs, they will come with pitchforks for Jerome Powell's head because food and energy prices have gone up, because they can't stomach that any longer. So the only thing, Jerome Powell is doing the right thing right now. He's raising interest rates and the effect of that is reducing the amount of money in the world and thereby reducing inflation. How this works essentially is that if the interest rate from the Fed is 4%, so when the bank issues a loan to, say me, I'm a consumer from a normal consumer bank, I want to take out a loan to go on holidays or to buy a house, the bank now can only get interest. They can only get money at 4% interest. So the only way they're going to loan out that money is if they'll at least get 5 or 6%. Whereas a couple of years ago it was 0%. And just so you're aware, that bank doesn't actually even need to have the money in their bank to be able to loan out the money. They can just print it out of thin air to give to me at 2% interest higher. So that's essentially how money is printed in the current climate. The consumer banks actually create the money, print the money out of thin air. And if it costs me like 10% interest to take out a loan, I'm much less likely to do that than I was when it was like 4% interest. And that basically means I'm not going to take out a loan to invest in a business. I'm not going to take out a loan to go on holidays and spend a lot of money, and that will reduce inflation. And that's the hope. And it hasn't really been working yet, but I think I'll explain why. But I think over the next few months and definitely the next year, we'll start to see inflation creeping back down, and that will allow the Fed to reduce interest rates again. But first, let me show you a few charts that will kind of shock you and make you realize why the Fed has no choice to eventually get the printers back on overdrive. And just as a side note, like, even some governments, my own government included, are printing money, or they're giving consumers money to offset energy costs. Like in Ireland, we're getting a couple of €100, like €400 each per household to help with our energy bills this winter. And I know California is doing that as well. So it's a little bit ironic to try and deal with inflation by printing more money to give to your consumers, but nevertheless that's what's happening. But at the moment, because of the last 10 or 20 years where we've had really low interest rates, there has been so much debt being taken on, and now we're the most indebted out of any time in history. And now that interest rates are starting to rise, we still have all this debt, but the interest on that debt has gone to the moon. So we can see this is the interest payments that the government owes on their bonds. So you can see for this year they're paying about $300 billion. Over the next 20 years, the interest payments on the US government's debt is going to be $8.1 trillion. And as a percentage of their tax revenue, at the moment it's about 7% of their tax revenue is going towards interest payments. So probably just about manageable. So look what happens over the next 10, 20, 30, 40 years. In 30 years time, the US government is going to be spending 40% of its tax revenue on interest. Where the hell are they going to get this money? They have three options. Option one, they can tax more by increasing the tax rates. So instead of me paying 40% tax of my income, I pay 60% tax, or I pay 70% tax. Or instead of paying 30% capital gains tax, I now pay 60% capital gains tax. So obviously that's not the most politically popular thing to do. But option two is they can reduce government spending, which, that's not going to happen. And option 3, the option that they've been doing the most over the last 10 or 20 years, they can inflate away the debt. I'll explain that in a minute. But probably the best solution would be kind of a combination of all three things, and maybe focusing on reducing government spending. But I'll show you why they can't do that either, really. So how do they inflate away the debt? So the way they do it is by, number one, they can print money, so they can buy their own debt, or they can lower interest rates. So that basically makes inflation slowly go up. It makes inflation go up, which means my wages go up. It means my stocks go up. It basically means I make more money. I pay more capital gains tax. I pay more income tax. But in reality, I'm not making more money. Like the price of everything has gone up, but the value of the debt has stayed the same. But the revenue that the government is getting in tax from capital gains tax and from income tax is way higher. So that's effectively how they can inflate away the debt, because now the debt is actually valued a lot less because the value of everything else in the world has gone up a lot. So it's to the detriment of anyone who's holding these bonds, or to anyone whose wage is only going up in line with inflation. That's reason one why I think they're going to have to print money again. I'll explain when I think they will have to do this, but that's reason one, because they have all these outstanding debts, all these bonds that they, government securities that they owe money on. They're not going to be able to pay them without printing money or lowering interest rates. Like, there's no way. As you can see, this is just too crazy. Number two is actually even more scary. The US government, just the US government, owes almost 200, doesn't owe it yet, but is liable for 200 trillion in unfunded liabilities. Unfunded means they don't have the money right now to pay it. So $200 trillion of unfunded liabilities. So that's a mixture of social security that they're going to have to pay over the next 50 or so years, 34 billion. And you can see this on usdebtclock.org, and the number is just keep going up and up and up over time. And the main one is pensions. So government pensions are crazy high, and they were super generous with pensions. Like, there's pensioners who are making like 200 grand, well, not making, because they're just getting these pensions, 200 grand a year. They're retiring early, etc., because they know they're gonna get a sweet ass pension. But now there's $200 trillion. Well, not quite 200 trillion, $172 trillion. And the United States is actually one of the best countries for pensions. Well, as you can see, United States isn't too bad in comparisons to EU and Japan. So basically what this chart is showing is the dependency ratio, meaning, so for example, in the United States, 43% the amount of pensioners as there is working age people. So basically, to have a economy that's working well, or that you'll be able to support the pensioners, is you need 3 working age people for every one pensioner. So you need 3 working age people to support one pensioner. But the United States is already over that limit. They're already at 43%. The Euro area, there's almost 60% the number of pensioners as there is working age people. And Japan, don't even get me started. Japan is extremely screwed, and you've seen what they've had to do in Japan in the way of printing money and lowering interest rates, because there's no way they can pay these liabilities without printing money, these insane pension liabilities. And the pensioners, the pension that they're getting is not going to be worth as much over time. So say they're getting 100k a year, the buying power of that by 10 years into their pension might even be 60% of what it was at the start, and then another 10 years. But that's kind of their only option, because you can see the liability per citizen in the US is $500,000. So where on earth are they going to get this money? I think you've worked it out by now. They're going to have to print it, they're going to have to inflate away this debt, and they're going to have to lower interest rates. But at the moment, like I explained, they have to keep interest rates high because inflation is killing everyone. But when are they going to U-turn? When is there going to be this pivot? So the market right now is pricing in that the pivot's going to be in May of next year. But if inflation starts to ease a bit before that, which I hope it might, Cathy Wood certainly thinks so. She thinks there's going to be deflation next year, which means deflation is even worse than inflation, believe it or not. And if there's deflation, yeah, they're going to be really whacking on the money printers at that point. But let's not get ahead of ourselves. We need to see the inflation rate start come down meaningfully before then. We can see like a lot of commodity prices have dropped significantly over the last year, and we're comparing to really high prices in 2021. So hopefully the inflation rate can come down. But the main thing the Fed and the main thing everyone is looking at is the price of energy, because that kind of dictates everything, and that's the most important factor when it comes to inflation. So in the short term, what kind of investments might do well before the Fed can pivot? They might take a few years to pivot, but say in the next 6 months to 1 year, anything related to energy could be a play. So any sort of metal mining, particularly copper, because that's used in for electricity, so EVs, etc. So copper miners, oil stocks, and finally gold and Bitcoin, because gold and Bitcoin are tied to the price of energy, because you have to use energy to mine them. So for the next 6 months, 1 year, 2 years, everything is going to continue being down only, probably. Like there might be ups and downs, but eventually, like once we get the green light from the Fed, it'll probably be a little bit before the Fed give the green light that they're going to have to turn the money printers back on. Most likely the U-turn is going to come in May of next year, but it could take longer. But that's all completely dependent on the inflation rate. So we have to keep on top of the inflation CPI reports. So I'll keep you updated on them. Just make sure you subscribe, hit the notification bell, and like the video if you did enjoy today's video. Thank you so much for watching. See you in the next one.